Welcome back to KTM Investing. We're going to focus more on the information today and not the images. So, bear with us as this video is quite long, but we feel it was necessary to clear up some misconceptions for the American people. Tonight, we examine how tariffs have impacted the U.S. economy, and why, for some investors, it may be time to reconsider exposure to U.S. equities before the window closes. Let's break down the facts. Tariffs have been a headline issue, but the real story is in the details. President Trump has repeatedly mischaracterized what tariffs actually are, and much of the public has accepted these claims, often without question. The reality, however, is more complex. Let's set the record straight. No country has ever paid the United States a cent in tariffs. And that's not about to change. To be clear, throughout history, not a single nation has paid a tariff directly to the U.S. government. That's a fundamental economic fact. Here's why. Tariffs are taxes imposed on goods as they enter the country, and they're paid by the importer, not the exporter. In other words, it's American businesses and consumers who foot the bill, not foreign governments as Trump would have you believe. For example, if the U.S. sets a 100% tariff on Chinese products, China doesn't pay a dime to the United States. The product ships from China, and when it arrives at a U.S. port, the importer, let's say Walmart, pays the extra 100% tariff imposed by Trump. If a toy costs $10 coming from China, then, with the 100% tariff, Walmart pays $20 to bring it into the United States. China's cost doesn't change. Only the American buyer, in this case Walmart, pays more. Are we seeing the picture yet? The impact is only felt here at home, not abroad. The only reason China would care about a 100% tariff is simple. If Walmart has to pay double to bring the product into the United States at the port, then they'll buy fewer products from China. That means fewer sales for Chinese manufacturers because Walmart has to pay $20 instead of $10 for the same product, so they purchase less. But again, China isn't paying the U.S. They're just selling less in volume to Walmart because Walmart can't afford to buy as much because Trump is charging Walmart 100% tariffs at the port. If tariffs rise too high, then Walmart may have to cancel orders from China altogether, which is the only reason China cares at all in the entire trade war process, and not because they have to pay a penny. That's the only real economic consequence for the foreign countries in this process. Just wanted to make that clear because it seems like this is largely misrepresented by the government, and a lot of Americans think we are getting money from other countries through tariffs. We get $0 through tariffs from other countries through tariffs. It all comes from our own businesses and our own citizens. Are we clear on that now? Okay, let us move on. Let's look at a sector where this is playing out in real time. Take electric vehicles. The tariff on Chinese EVs is now 145% or higher. If a Neo costs $49,000, after tariffs, it's over $130,000 in the US. That's a deliberate move to make advanced Chinese EVs unaffordable, even though they often surpass American models in quality and technology. The result? U.S. consumers pay more for less advanced vehicles, all in the name of protecting domestic industries. Sometimes these policies come at a real cost to everyday Americans. It's a classic case of protectionism, and the consequences are far-reaching. Let's put this in perspective. Imagine if the world had responded the same way to computers, railroads, or satellites. Where would we be now? What if we'd protected switchboard jobs instead of embracing digital phones? Sometimes these measures are simply counterproductive. The global economy rewards innovation, not isolation. And that's a lesson worth remembering. Now let's talk about the international response. The U.S. has strained relationships with key allies. Canada and Japan are seeking new partnerships, while Singapore, India, Vietnam, Brazil, and Russia are holding talks to move forward, with or without the United States. The world is realigning and the U.S. risks being left behind. These countries are moving away from the U.S. dollar as the world's reserve currency, and away from SWIFT as the default for global money transfers. Alternatives like Ripple, XRP, and global ACH are gaining traction. The financial landscape is shifting. It's a trend investors can't afford to ignore. The BRICS nations, Brazil, Russia, India, China, South Africa, Malaysia, Indonesia, Saudi Arabia, and others, are leading the charge on de-dollarization. Their goal? Reduce the U.S. dollar's role in international trade. It's a coordinated effort with major implications for global finance. The momentum is building. Today, BRICS accounts for 35% of global GDP, while the U.S. and G7 represent just 30%. The balance of power is shifting. Recent moves have pushed Canada and Japan closer to BRICS, effectively turning the G7 into the G5. Soon, BRICS could represent over 40% of the world's GDP. That's a seismic change in the global order, and it's happening fast. Meanwhile, China and the European Union have reached agreements on electric vehicles, opting for minimum EV pricing instead of tariffs. This benefits companies like NIO, and signals a new era of cooperation in the global auto market. Japan, for its part, is considering pulling out of US-based businesses due to recent tariff policies and legislation. There's even talk of closing American plants that employ over 1.5 million US workers. The stakes are high, but the impact goes beyond markets and currency. Across the US, farmers are feeling the effects of tariffs firsthand. Many are turning to gig work just to make ends meet, and some are on the verge of losing family farms that have been passed down for generations. When these families seek SNAP benefits, they find those programs have been cut. Medicaid cuts have hit hardest among white Americans. 43 million receive benefits compared to 23 million Hispanics and 20 million African Americans. Contrary to common belief, white Americans receive food stamps and Medicaid at double the rate of any other group. The data tells a different story than the headlines. It's a reality check for policymakers and the public alike. So, when the president says able-bodied Medicaid recipients should work the fields, he's talking primarily about white Americans. That's a fact worth considering. Meanwhile, the world is moving on from U.S. crops. American exports have failed to meet international chemical standards, and recently, U.S. corn has been rejected at overseas ports. It's a wake-up call for the agricultural sector. Canada and Brazil have stepped in as new suppliers, securing contracts that are unlikely to return to the U.S. Even though American corn is cheaper, global buyers are paying 20% more for Canadian and Brazilian corn, prioritizing quality and safety over price. The world is voting with its wallet. As a result, the U.S. is left with millions of unsold products, far more than can be consumed domestically. Much of it will simply go to waste. Right now, the stock market remains elevated, but that's a lagging indicator. Companies stockpiled goods in anticipation of tariffs, but as reality sets in, the numbers will start to reflect the true impact. The adjustment is coming. In the private sector, job growth has stalled. All recent gains in non-farm payrolls came from government hiring, not the private sector, which has seen layoffs at major firms like Microsoft, Walmart, Amazon, and Google. No major company is ramping up hiring. That's a red flag for the broader economy. Investors should take note. Let's turn to the housing market. In most parts of the U.S., home prices far exceed what average salaries can support. For a $400,000 home at a 6.5% interest rate, the monthly payment is $2,528, requiring a monthly income of $8,742 just to qualify for the mortgage. That translates to an annual income of $104,904. Many families, even with two incomes, don't reach that threshold. And for single-income households, it's even further out of reach. With the rising cost of groceries, gas, and utilities, real estate has become unaffordable for most Americans. That's why so many homes are on the market, and so few buyers are stepping forward. In today's housing market, it's not that Americans don't want to buy a home, it's that many simply can't qualify for a loan, even if they're interested. And here's the kicker. While we've been using a $400,000 estimate, the actual average price of a home in the U.S. is now $420,000. That puts homeownership even further out of reach for most families. It's a reality that's reshaping the American dream, and it's just the beginning of a much larger story. Rising property taxes are compounding the problem, making it nearly impossible for many to stay in their homes. Retirees on fixed incomes, especially in states like Florida, are being squeezed out by higher assessments. Imagine, you've paid off your house, you're living on $1,500 a month in Social Security, and suddenly, your property taxes jump to $7,000 a year. That's a life-altering decision point, and if your insurance premiums spike after a hurricane, sometimes the decision is made for you. At that point, it's out of your hands. These are the pressures shaping the market, and they're not going away anytime soon. So what's next? The housing market is poised for a correction. Meanwhile, countries are steadily moving away from the US dollar, and our farming industry continues to struggle. Interest rates remain high due to inflationary pressure, and even if a new Fed chair is appointed, the Federal Reserve is a committee, not a one-man show. That's a point often misunderstood. Tariffs, let's be clear, are a tax on the American people. Claims that we're collecting tariffs from other countries are simply false. It's impossible to collect a tariff from another nation. Look it up if you have doubts. As these realities set in, the stock market is likely to follow suit. Major Wall Street firms will short the stocks they expect to fall, making profits on the way down, and they'll invest in international markets, including China, that they've previously told you to avoid. It's a global shift, and it's happening now. So, what can you do to protect yourself? Let's talk strategy. First, consider diversifying your investments. International opportunities are on the rise, the world is changing, and so should your approach. Let's break down some actionable steps. What you should do to protect yourself. One option, invest in the Chinese market through ETFs like MCHI, a dividend-focused Chinese fund. It's a way to gain exposure to growth outside the US. Another, KGRN, which targets a different sector of the Chinese market, offering broader diversification. CQQQ is also worth a look. It's a bit pricier, but it's a stable Chinese ETF with strong returns and solid exposure. And finally, consider NIO for direct exposure to one of China's most innovative EV companies, a true leader in the future of electric vehicles. NIO's battery swap stations are a key differentiator in the competitive EV landscape, setting them apart from the rest. These innovations provide deep insights into local consumer preferences, help navigate complex regulations, and reveal the nuances of each market. Looking ahead to 2025, NIO plans to expand further. With entries into France, Switzerland, a market known for its discerning consumers and high standards, Austria, with its strong automotive culture and growing interest in electric mobility, Belgium, strategically located in the heart of Europe, and most notably, the United Arab Emirates, signaling a significant expansion beyond the European continent. The UAE's appetite for luxury tech, combined with its strong push for green initiatives and sustainable transportation, makes it a strategic growth market, offering significant potential for NIO's premium electric vehicles. This expansion is crucial for diversifying NIO's revenue streams beyond its core markets in China and Europe, reducing reliance on any single region. Each new market is carefully selected based on a comprehensive analysis of EV adoption rates, government incentives, and overall income levels. It's a data-driven approach to expansion, minimizing risks and maximizing the potential for success. Unlike its earlier capital-heavy strategy, which involves significant investment in infrastructure and direct sales, NIO will now increasingly rely on strategic partnerships with established dealerships and local players. This approach allows for faster, more cost-effective market entry, leveraging existing infrastructure and expertise. This strategic shift allows NIO to scale its operations more quickly and efficiently, while simultaneously minimizing financial risk and overall investment in each new market. NIO's world is expanding at an accelerated pace, driven by a clear vision and a well-defined strategy, but this time its strategy is smarter, more agile, and ultimately more sustainable for long-term global success. For NIO, the global stage is set, and the next act is just beginning. Tonight we turn to the Onvo L60, NIO's first step into the mass-market SUV segment. This isn't just another vehicle launch, it's a pivotal moment for the company. A strategic move designed to broaden its reach and capture a much wider audience. For NIO, the L60 marks a new chapter, one that could redefine its future in the global auto industry. The L60 is going head-to-head with the Tesla Model Y. NIO aims to match Tesla's advanced technology, but at a price point that's more accessible, more competitive. That makes the L60 a compelling alternative in the electric SUV market and a direct challenge to established players. Built on a state-of-the-art 900-volt platform, the L60 brings impressive technical specs to the table. It's a leap forward in engineering and a clear signal that NIO is serious about innovation. This advanced architecture enables ultra-fast charging, dramatically reducing wait times at the plug. It also delivers top-tier energy efficiency, maximizing range and minimizing consumption. For drivers, that means more time on the road, less time charging. The result? The L60 is an ideal choice for families focused on cost savings and convenience. It's designed for daily life, practical, efficient, and ready for the demands of modern households. Step inside, and you'll find a spacious, thoughtfully designed, minimalist interior, a space that feels both modern and comfortable. The intuitive software interface is tailored to the evolving needs of today's families. It's all about a seamless, enjoyable driving experience for everyone in the car. Crucially, the L60 leverages NIO's innovative battery swap network. This is a key differentiator in the EV market, one that sets NIO apart from the competition. With battery replacement in under 3 minutes, range anxiety becomes a thing of the past. For drivers, it's unparalleled convenience, a true game changer. In China, the L60 opens the door to the largest and most competitive EV segment. It positions NIO for significant growth in its home market and sets the stage for what's next. Globally, the L60 is NIO's ticket into high-volume, tariff-sensitive markets like Europe. Here, affordability and practicality are the keys to success. The launch of the Onvo brand signals a fundamental shift in NIO's strategy. No longer just a niche premium player, NIO is now a serious contender for the mass market. This move is all about scale, achieving greater economies and boosting overall profitability. It's a calculated step toward long-term growth. The L60's success will be absolutely critical to NIO's ambitious delivery targets for 2025 and beyond. It's the linchpin for the company's next phase. But looking ahead, the introduction of the L90 will be just as crucial, driving improvements in profit margins and overall financial performance. It's more than just a new model. The L90 represents the cornerstone of NIO's entire volume growth strategy, a foundation for the company's future. In 2025, NIO is making a decisive shift, moving away from the high-cost NIO houses. This marks a new era for the company's global ambitions. Instead, NIO is embracing a dealership-based model for overseas sales and service. It's a move designed for speed, scale, and efficiency. By partnering with established automotive retailers, those who know their markets best, NIO can tap into local expertise and infrastructure right from day one. The result? Upfront costs are slashed and market entry accelerates. It's a strategy built for today's competitive landscape. Leveraging local knowledge means NIO can adapt quickly and stay ahead of shifting consumer trends. This approach transforms fixed costs into variable ones, tying expenses directly to sales performance. That means NIO only spends as it grows, a model that supports rapid, scalable expansion. The company is also expanding its battery swap network through new partnerships, sharing costs and driving broader adoption of its technology. This asset-light model conserves cash and creates a powerful network effect, turning proprietary tech into a potential industry standard. The shift frees up capital for research, development, and next-generation vehicles, making NIO more agile and responsive to market changes. It's a pragmatic evolution, positioning NIO for sustainable, profitable global expansion. NIO's shift to an asset-light model marks a pivotal moment for the company. This is a strategy designed to reshape the financial landscape, streamlining operations and focusing on efficiency. The result? Major financial benefits. By reducing overhead, NIO is positioning itself for long-term stability and growth. Capital and operating expenses tied to global expansion are being slashed, a move that's resonating with investors and analysts alike. Transitioning to a dealership model means NIO no longer needs to invest in costly NIO houses overseas. That's a significant reduction in fixed costs. Over the next 2 years, this shift is expected to save the company hundreds of millions of dollars. That's real money back on the balance sheet. NIO is also outsourcing the construction of its battery swap stations, a move that further reduces direct capital outlays. In fact, this approach could cut those costs by up to 70%. That's a dramatic improvement in capital efficiency. The result? More cash preserved for core operations and greater flexibility to respond to market changes. These moves are projected to reduce NIO's international cash burn substantially. It's a critical step for maintaining momentum in a competitive global market. By 2025, NIO expects to cut its overseas cash burn by more than 40%. That's a powerful message to investors. With a longer financial runway, NIO is boosting investor confidence and setting the stage for future growth. Lower sales and administrative costs will help offset thinner margins from the more affordable Onvo L90. It's a balancing act, but one that's carefully calculated. Meanwhile, battery swap partnerships are opening up new, high-margin revenue streams, a key part of NIO's evolving business model. Licensing fees and battery-as-a-service subscriptions from third-party automakers could soon become a significant profit driver. It's a model with real potential for scale. The bottom line? NIO is building a credible path to improved gross margins and positive cash flow. This new model is designed to bend the cost curve and unlock sustainable profitability for the future. For NIO, it's not just about cutting costs. It's about building a foundation for long-term global success. The road ahead is challenging, but the strategy is clear, and the financial impact could be transformative. For 2025, NIO is setting its sights high, targeting between 50 and 60,000 overseas sales. It's an ambitious goal, and one that signals a major push beyond its home market. The company is also preparing for entry into new markets, including France and the United Arab Emirates. These regions represent significant growth opportunities for the brand. Now, let's talk about the L90. Its affordability, paired with strong family appeal, is expected to drive substantial volume, especially in Europe, where tariffs and price sensitivity remain top of mind for consumers. The L90's competitive pricing is a key advantage, and it's designed to resonate with families looking for value and innovation. In fact, this family-first approach is expected to be a major catalyst for growth, particularly as European buyers weigh their options in a rapidly evolving EV market. Europe, with its sensitivity to tariffs and pricing, stands out as a critical battleground. NIO is positioning itself to compete head-to-head with established players. Meanwhile, the shift to a dealership model is enabling NIO to roll out quickly and penetrate markets more deeply than ever before. This approach means faster access to customers and a stronger presence in key regions. The United Arab Emirates in particular is poised to become one of NIO's top 3 international markets. It's a strategic move and one that could reshape the company's global footprint. Achieving these ambitious targets will provide the scale needed for improved margins and a more diversified revenue base. Diversification is key. By expanding internationally, NIO reduces its reliance on any single market, building a stronger, more resilient business. Ultimately, success in this international push will be a critical indicator, a true test of NIO's ability to become a global force in the electric vehicle industry. All eyes are on NIO. Investors are watching closely to see if the company can deliver on its ambitious growth plan and set a new standard for global expansion. The next year will be pivotal. Every move, every milestone will be scrutinized by the market. For NIO, the challenge is clear, but so is the opportunity. The world is watching. NIO's battery swap technology just got a major boost. In a move that could reshape the industry, Beijing has stepped in with a game-changing endorsement. The Chinese government has now given its official stamp of approval, a clear signal of confidence in NIO's innovation. With national standards now built around NIO's technology, the company is no longer just a car maker. It's positioned as a foundational player in China's energy infrastructure. This opens the door to new partnerships. Major automakers like Geely and Changan are now in play. For NIO, that means competitors could soon become customers, tapping into its battery swap network. Each time a partner brand uses a NIO battery swap station, it generates high-margin, recurring revenue. Think of it as a subscription model, steady, predictable, and scalable. The more automakers that join, the more valuable and entrenched NIO's network becomes. It's a classic network effect. Momentum builds and the advantages multiply. Internationally, China's backing gives NIO's swap technology real credibility. It's now a state-sanctioned, industry-standard solution, a powerful message to global partners and governments. That support strengthens NIO's pitch as it rolls out infrastructure worldwide. NIO is now exporting a proven, standardized energy solution, and that gives it a unique edge over global EV rivals. In short, NIO's battery swap network is no longer just a feature, it's a revenue engine, a competitive moat, and a potential industry standard. For investors and industry watchers, this is a turning point. NIO's management is setting its sights on break-even profitability by the fourth quarter of 2025. It's an ambitious target, one that's drawing attention across the global auto industry. The driving force? Surging sales of the Onvo L90, NIO's new mass-market contender. Executives say this model is already reshaping the company's growth trajectory. But it's not just about sales volume. Strict cost controls are also in play, with management tightening spending across the board. Higher volumes, of course, mean improved margins. As production ramps up, NIO expects to see significant gains in efficiency. That's the power of economies of scale, a key advantage as the company grows. Meanwhile, NIO's asset-light model is lowering the break-even point, making profitability more attainable, even in a volatile market. Another major factor, battery swap partnerships. These deals are expected to generate high-margin, recurring revenue, adding a new layer of stability to NIO's financials. The result? A more diversified income stream, less dependent on any single product or region. If NIO delivers on these targets, the company could be poised for a major revaluation in the eyes of investors. We could see NIO valued not just as a premium automaker, but as a high-growth energy services provider as well. That dual identity, car maker and energy innovator, could be a game-changer for the company's long-term prospects. A successful Onvo launch combined with a robust battery swap network may help close the valuation gap with rivals like Li Auto. Sustained profitability would likely attract new institutional investors and could prompt analyst upgrades across the board. For CEO William Li, achieving these goals would be a powerful validation of his vision for NIO's future. It would also mark the beginning of a new era of growth for the company, one defined by innovation, scale, and global reach. As the countdown to Q4 2025 continues, all eyes are on NIO to see if it can deliver on these bold promises. For now, the roadmap is clear, but the next 18 months will be critical in determining whether NIO truly becomes a global leader in the EV revolution. NIO stands on the brink of transformation. The company is entering a new era, one defined by bold strategy and decisive action. With a pragmatic approach, NIO is addressing past challenges head-on, while doubling down on its core strengths. This is not just a pivot, it's a calculated evolution. The company is leveraging what it does best and building for the future. It's a strategy rooted in experience but focused on growth. The shift to a lean, asset-light model is central to this transformation. NIO is streamlining operations, cutting unnecessary costs, and focusing resources where they matter most. And with the launch of the Onvo L90, NIO is signaling its intent to compete at scale, not just in China, but on the global stage. This positions NIO for high-volume international growth. It's a move designed to capture new markets and drive the next phase of expansion. Geographic expansion into Europe is already underway, with the Middle East next on the horizon. These moves will diversify revenue streams and reduce reliance on the Chinese market. For NIO, that's a critical step, one that positions the company to weather global volatility and seize new opportunities. Government endorsement of NIO's battery swap technology creates a powerful competitive moat. It also opens up entirely new revenue streams and sets the stage for industry leadership. All these elements, strategy, innovation, and expansion, converge on a single goal: sustained profitability by Q4 2025. That's the target, and the company is moving with purpose to get there. The roadmap is clear. The pieces are in place. Now it's all about execution. Over the next 18 months, every decision, every milestone will be critical. The world and investors are watching. The question for investors is simple. Is now the time to bet on NIO's global renaissance? Only time will tell.